welcome and a very good day to all viewers out there. Today we're going to have a lecture on MFRS 137 provisions, contingent liabilities and contingent assets. For information, MFRS 137 is equivalent to International Accounting Standards 37 that is issued by International Accounting Standards Board, previously known as International Accounting Standards Committee. Let's start. So there are topic outcome that we will have to achieve by the end of the lecture. So our topic is on provision. So you should be able to define provision, define contingent liability, distinguish between provision and contingent liability, difference between provision and liability, recognition of provision that give rise to liability, accounting treatment for the provision, and contingent liability, define contingent asset, explain recognition of contingent liability. Contingent liability is not recognized. Contingent asset also is not recognized. Explain the change in provision, explain disclosure requirement as per MFRS 137, and also knowing the local Malaysian private entity reporting standards for provision and contingencies. And PERS, which is also equivalent to FAR270, which is issued by International Accounting Standards Committee. This is the objective of MFRS 137, which is to ensure appropriate recognition criteria are being used, as well as the measurement basis being applied to accounting for provision, contingent liabilities, contingent assets. And also to ensure sufficient information are being provided by way of notes to the account being disclosed, as well as showing what are the nature of the event, the timing, as well as the amount involved. With regards to provision, contingent liabilities and contingent assets. So we'll first start off with provision. Later we'll proceed with contingent liabilities, and the last part is on contingent assets. So we start off with, of course, knowing the meaning or the definition of provisions. So in a simple word, provisions are liability, but it is a liability with uncertain. The word here is uncertain. Uncertain has some element of substantial estimation, certain timing, and also uncertain amount. So, but it starts off with the word liability. So if you can still recall, the liabilities definition is given in the conceptual framework. It's present obligation. So I use the word PO here, present obligation, as a result of past events. So you need to know what is the nature of this so-called present obligation. And that present obligation, or in a simple word, commitment, will be settled later through outflow of resources from the entity. So assuming we are the reporting entity, so it will involve outflow of resources. However, when we talk about provision, those liabilities will involve some element of uncertainty, where when we talk about uncertainty, it will involve some degree of estimation in terms of when is the timing, as well as how much is the amount. Next. Just now we said that present obligation as a result of past event. So the word past event, what is the meaning of the word past event? What are those past events that give rise to present obligation? So according to MFRS 137, past event is giving rise to present obligation if it is probable. The word probable means you are not sure, but the chances that it will happen is going to be 50%. The chances that there will be a present obligation by the end of the reporting period is more likely than not, which is more than 50%. Yeah, 60%, 70%, 80%, that the chances an event will occur. So when I say an event will occur, if you are held liable, 50% chances or more that our company will be held liable for the obligation that we have involved ourselves with. However, according to MFRS-137, you can read this, it may not necessarily lead to an obligation. Not all past events will lead to obligation. Normally, you need to take into consideration those evidence and also opinion of the experts. Experts like lawyers, experts like directors, maybe the architects, maybe engineer. They are the experts when it comes to their field, right? The professional field. The evidence can also be those additional evidence that are provided by events after reporting period. So meaning that this MFRS can also be read together or has some effect to the MFRS 110 as well, which is on events after reporting period. We go to the next part. So if we say that past event, will give rise to present obligation. So we are saying that past event has given you some kind of obligation. So that is what you call obligating event. So obligating event is event that creates either a legal obligation or a constructive obligation. They create some kind of potential legal obligation or constructive obligation that the company will have no relative alternative to not settle the obligation. So the commitment will give rise to some kind of future obligation. What are legal obligation? Legal obligation, the word legal has something to do with laws. So there are the obligation that are derived from a contract. Maybe a contract between us and our supplier, or maybe a contract between us and our customer, through whatever explicit or implicit terms and condition. Legislation, maybe legislation that are passed by the regulatory authorities by a country, the one that is being enacted and also being enforced, and also other operation of law. Any kind of rules and regulation of maybe a local authority or a particular regulatory authority that has a power to enforce that law to be held or to be followed by the entity. The next one is constructive obligation. Constructive obligation are normally derived through the entity's action. And entity's action somehow has created some kind of established pattern. And that pattern which is being established are normally through the past practice that has been done by the company, the published policies, past practice through the repeated action from time to time, the same action from time to time, or a published policies. They have a policy that they made it known to the public. They made it known to the other parties, to the community at large, or to the parties affected. Specific current statement made by board of directors, statement made by those person with the authority, some kind of announcement made via radio, TV, via website, via Twitter, via maybe Instagram account, which are the official statement of the company. We're not talking about viral information. We're talking about those with some official statement, right? That has indicated that entity will accept certain responsibilities, and normally the constructive obligation will create a valid expectation that our entity, yeah, will discharge our responsibilities. We are going to discharge our responsibilities to whom? To the other parties, to the market at large, right? To the community at large, whoever the parties affected by. These are some points that you can note that are further explanation on what are past events. Yeah, so this perhaps you can read on your own, but most importantly is that past events are the one that give rise to present obligation, and that will require you to consider a provision to be made, and liability that exists at the end of reporting period are the one that can be recognized as a provision if it meets the recognition criteria. And obligation normally will involve commitment to the another party. So obligation normally will involve commitment. However, it's not necessary for a company to know the identity, each and every identity of the parties affected by. It's enough to know that there are parties affected. Legal obligation are normally those legislation that are being enacted, or it is virtually certain that it will be enacted by the end of the reporting period. So once the ones that are being enacted, the laws, the act. Now, first example here is about looking at obligating event. So our example here is trying to show whether there is a legal obligation or a constructive obligation. Recall, legal obligation has something to do with contract, yeah, something to do with publish policies, and also something to do with past practice. Okay. And constructive obligation has something to do with the action of the entities that has created a valid expectation, which is through the published statement, right? Published statement made by the company, through specific announcement, and also through the past practice. You can check back what I mentioned just now. So now let's look at the example from Leisure Village Berhad. So that has caused a severe damage to the habitat of wildlife. So this one is actually the past event. I put it in red. And because of that, yeah, however, the country has no legal protection. They have a legal protection, sorry, for wildlife. So there's a law to protect the wildlife. That means to say that there is a legal obligation. So, and the company is required to pay a damage cost of 100,000. So there is a legal obligation of the company to pay for the damage costs. Why? Because there is a legal protection. You can see that I have underlined the keyword there. Second one, a retail store has a policy of refunding purchases by dissatisfied customer. For the customer that are dissatisfied with the purchase made earlier, the company is well known for its policy of making refund. So remember I told you earlier about published policy for the constructive obligation, right? So the word policy here refers to the constructive obligation. So it's constructive obligation. And you can read at the bottom here, the past policy of the company has somehow created a valid expectation that the company will refund purchase to the customers if they are dissatisfied. So constructive obligation, legal obligation. The third one, if you look at the word here, is the practice of the company. Not just the first time, but it has become a practice for the company to pay annual vacation. To whom? To those employees that achieve the annual sales target. However, that was not written in any of the contract. So meaning that it is because of the past practice that it has created a valid expectation to the employees that the company is likely to repeat the same practice again. So there is a constructive obligation. However, if this is written in the contract, here it's not written, right? If it's written in the contract, it means that this is not a constructive obligation anymore. It becomes a legal obligation. The next one is about Sumber Alam, a company that involved in exploring oil, maybe in the deep China Sea, right? Causes contamination. So the Sumber Alam has caused contamination to the seawater, and the contaminated area somehow needs some clean up, and that was a requirement by the regulatory authority. So the past event is the contamination cost. This is the past event. However, because there is a regulatory authority, so meaning that there is a legislation that requires for clean up, there is a law that requires this to be done. So therefore, there is a legal obligation. We go into the next part. So when we talk about past event that give rise to present obligation, this is one of the important criteria for us to understand before we can recognize there is a provision. So according to MFRS 137, you will recognize a provision if all three conditions, all three, are being fulfilled. 1, 2, 3. Number 1, there should be a present obligation as a result of past event. I've already explained this. Present obligation, either present obligation, legal obligation, or present obligation, constructive obligation, either one. Right? So now this one must be fulfilled. Number 2, the outflow of resources is probable. I mentioned earlier, probable means the chances of happening is more than 50%, normally based on the expert opinion, the lawyer, the director that has experience in that particular field, or the lawyer which has that record of having the legal knowledge in that matter. So they say it's probable. Probable means it's likely that the company are going to settle the amount required for the obligation. So more likely to settle, meaning that 50% to be held liable. Outflow is probable. Next one is reliable estimate. So this has been met, must be met, this must be met. The second one. The third one is reliable estimate. So if you have an outflow that is probable, you should also be able to measure the estimate of the amount. So the estimate of the amount is estimate of the amount of the obligation, as well as the timing. How soon will you need to settle the obligation? Is it in 3 months' time? Is it in 3 years' time? Or how much is the obligation? So reliable estimate should be made normally on the amount of obligation, because sometimes timing are not within our control. The timing is within the control of the court, right? Sometimes. Next one is you need to understand that if those three criteria are being met, that is only when you recognize a provision. However, if any one of the above criteria, any one of the above three conditions, let's say only 2 out of 3, or maybe 1 out of 3, only 1 out of 3 or 2 out of 3, that means there is no provision, right? So you only will recognize a provision if it is 3 out of 3. All three are being met. So provision shouldn't be confused with depreciation, provision for depreciation, or any provision for uncollectible receivable. Our provision here are rather more on the provision of uncertain timing and amount, right? So liabilities. So it's not about trying to adjust the liabilities carrying amount, right? So you can read this on your own. Next, recognition of provision. So when you recognize a provision, normally there is an effect to the debit, credit, or accounting effect of a provision. So if you look in the SOPL, So if you recognize a provision, we say it's a liability, right? So you are going to credit a liability, and that liability is called provision. Let's say just now was provision for damage. Remember the damage done to the seawater. And this is a liability, right? So let's say the amount is 100,000. We estimate that. So there is already an increase in liability because of that credit transaction. And the debit would be to the damage expense. Damage expense will normally appear in the SOPL. Let's say another 100,000. So when you debit the damage expense, there is an increase in expense. When there is an increase in expense, there is a decrease in profit. And when there is an increase in liability, that ratio will also goes up or increase. Next is the measurement of the provision. So provision is normally being made based on the best estimate, determining the amount of provision should normally be based on the best estimate. Estimate as determined maybe by the lawyer, the board of directors, to settle the present obligation. The remaining 4 you can read on your own, but our focus will be more on the first one. But of course, as you determine, you need to also look at the risks, what are the present value, future event, and also if there is any other effect of gains to the measuring of provision. Let's look at the first example on provision. Provision here is on warranties. The word warranties, and this is something to do with legal obligation. Court members give warranties at the time of the sale to the customer. So the sale to the customer is the past event. Warranties is the legal obligation. There is a present obligation by way of legal obligation. And that was happening because there is a contract as well as there is a warranty for the sale of the product. The manufacturers say that they are going to undertake to make goods by repairing or replacing and manufacturing defects that become apparent within 3 years from the date of sale. So the warranty is for 3 years. So the first one, there's a present obligation as a result of past events. So number 1 has been fulfilled. Then on the past experience is probable. So number 2, OP, outflow is probable. Number 1, there is a present obligation. Also fulfilled, probable, more likely than not, chances of happening more than 50%. Likelihood to happen is more than 50%. That's probable. And there will also be some claims. That is why it becomes probable. They are likely to get claims every year for the warranty. Based on the previous experience, the company estimates. So the estimate can be made at 15,000. So the reliable estimate are being made, and outflow is also probable. So number 3, reliable estimate. So you are required to do that actually. If you read here, first one is about asking you to go and do and check whether there is a present obligation. Outflow is probable. Third one is about reliable estimation. The fourth one is on whether there is a provision. So if 1, 2, 3 are met, there is a provision. And number 5 is whether there is an adjustment. So that is what we have analyzed in the question. And the full answer is provided in this slide 15. You can go through and you will see that first one is yes, second one is yes, second criteria, third criteria is yes. Just pay attention that the first one is about present obligation as a result of legal obligation. And I put the color there. For the past event, I use red. For the legal obligation, I use purple. For the outflow that is probable, I use light blue. For the reliable estimate, I use light green, right? So those colors will be able to tell you which particular conditions are being met. So those are actually from the question. So if 1, 2, 3 are met, so all three are met right here. So therefore, yes means you will recognize a provision. What kind of provision? Provision for warranties. Where to recognize? Recognize them as a liability. Where specifically? In the soft B, or you can say in the financial statement before you finalize your accounts or before your directors authorize that for issue. Explain the accounting treatment under MFRS 137. So when you're asked to explain, you need to write that in sentence. So it's best that you can just do the journal first, then from the journal, try and explain that in your words. Right? So provision for warranties shall be recognized. Recognized means recognized in the financial statement. Then mention about the adjustment that you need to make, where you increase your warranty expense and you also increase your provision for warranties. And because this question asks you to show journal entries, you show the journal entries as well. Next one is the example that involve constructive obligation. Yeah, is also doing the same analysis. So in this example, there are no environmental legislation for the country in which the same company just now called Mammoth, operates. The company has somehow established constructive obligation by setting a valid expectation to the other parties. How? To the widely published policy. So remember, for the legal obligation, I use purple. For the constructive obligation, I use brown. So if you look at brown here, it shows that has something to do with constructive obligation. And the one in red is the past event, clean up all contamination that it costs. So that means that contamination caused by the company is the past event. The entity has a record of honoring this published policy. So in the past, they have been publishing that environmental policy that they will clean up the cost. So they have the record of honoring this published policy. When they have a record of honoring this published policy, the outflow is probable. Of course, the first one has been met, present obligation as a result of past event, and it has something to do with constructive obligation. The third one is to check whether there is a reliable estimate. Yes, there is a reliable estimate of 300,000. It can be made maybe based on the information or the views of the directors together with the experienced legal advisor, and they say it's 300,000 that you need to spend to clean up the environment, to clean up the contamination costs. So all three are being fulfilled. So of course, you need to check this. We have checked, and because we checked and we know that they are being fulfilled, a provision will be recognized. So you can also make adjustment. You can check the answer in the next slide 17 here, where the analysis is of course looking at the recognition criteria, and you may have to make sure that all three are fulfilled. So here our first one is POCO, second one is outflow is probable, third one is reliable estimate. And you can write the sentence. So write the sentence by taking those words from the question. So present obligation result of past event here is because the company has cleaned up the contamination costs, and that becomes their published policy. Second one, the outflow is probable because they have a record of honoring the published policy, this one here. So the blue one, remember I told you, is for the outflow is probable, right? And 300,000 reliable estimate is to show that estimate can be reliably measured. So all three are being fulfilled. And of course, we can come with a conclusion. The conclusion is to recognize a liability in the financial statement of 300,000 based on the reliable estimate. And adjustment, you are going to show them to adjust by increasing again the clean-up costs in the SOPL and increasing the provision in the SOFP and show the journal entry, debit the expenses with 300,000, credit the provision with 300,000. So the effect of those example 2 and example 4 is shown in example 2 and 3, sorry, is shown in example 4. The example 4 are asking you to prepare the statement of profit or loss showing the effect of the provision as well as statement of financial position by the end of the reporting date. So this is the effect. I put this, you can put under other operating expenses, and you can have a notes to the account explaining the movement of the provision as well. What is at the beginning, what is at the end. So these are put under current liability, assuming that it will be settled within less than 1 year. If that is likely to be settled more than a year, it will be put under non-current liability. So you can see here the word provision is showing the liability. Example 5 is about YH. It's in the process of finalizing financial statement for the year ended 30th June. So look at the year end or reporting date of the company, 30th June. And after the reporting date, so this is the reporting date. And 10th of July is somewhere after 10 days. The owner of the adjacent building, adjacent next to you, yeah, the one, not the one in front, but the one maybe to your left or to your right, adjacent, file a case against our company YH claiming for 500,000. So meaning that there is already some kind of legal obligation. Why? Because of the legal suit being made by the owner of the building next to you, and therefore there is a present obligation already. The claim is made, why? Because of the past event that has caused severe damage. Remember, red is for past event, the purple is for legal obligation, 500,000, or the one is in green, that one is for reliable estimate. Now the claim by the owner, he is in the view that YH was negligent in maintaining fire safety system. We are negligent, so they are suing us for negligence. According to our lawyer, there is a 70% probability, which is more than 50%. So the outflow is probable. So first check, second also check, number 2. And you, according to the lawyer, will need to pay 40% of the amount claimed. So they claim for 500,000, but lawyers say the reliable estimate is only 200,000. How much? 40% times 500,000. So checked. So all three are fulfilled. 1, 2, 3. You asked to discuss this. So if earlier what we did was to first, talk about the criteria first, and then only give the conclusion. But in this example, what I did was I start off by making a conclusion because I know that the 3 criteria has been met. So a provision for damage, I put the reliable estimate there, should be recognized. Why? Because it meets the criteria under MFRS-137. It meets the required criteria here, all 3, right? So there is a present obligation arising from past event. You need to explain that there is a legal obligation. Why the owner has already filed a case claiming for the damage because of the past event. Remember, red is for the past event. And second one, so then after explaining that, you need to talk about outflow, whether probable or not. If it's not probable, that will give rise to our next section, which is contingent liability. But this one is probable, chances of more than 50% that we will be held liable or will be found guilty, right? Meaning that we are going to lose the case if the owner of the adjacent building file a case, so we will lose the case, right? So the chances is more than 50% that we will lose. So therefore, outflow is probable. The liable estimate is 200,000 based on our calculation. So therefore, a provision is recognized. Okay, that's it for our first section, which is on provision. We will continue with our second part on contingent liabilities in our next video. I hope you have understood the first part on provision. Do make revision. Do go through my examples. I'll see you when I will see you. I will see you with examples and explanation on what is contingent liability.